Bandhan Mutual Fund presents MF Corner.
Hello and welcome to MF Corner, the special edition on YouTube. Now, today what we're going to be diving into is a topic that is absolutely essential, and that is especially to secure your wealth. Normally, you talk about where you should be investing in mutual funds, but let's take a step back, talk about how you should secure your financial steps and future. What are the steps you should be following in financial planning, whether you should just start your financial journey or looking at refining your strategy. Understanding these steps are going to be important. To talk to us about that today, we do have our special guest joining in with us on the show. We have Anant Ladha, who is joining in with us who's the founder of Invest Art for Cull EduTech Private Limited. Anant, thank you so much for joining in with us on the show. And it's very, very important to understand financial planning before we dive into investing in a lot of options that we have today. What are these steps that we should take?
Hi, firstly, thank you so much for having me on the show. Very excited to have a very meaningful conversation out here. See, first step and the starting step, which I feel is to get ready with your term insurance plan. I think we jump onto the investment really quick, but firstly, we need to secure our family just in case we are not in this world. Something happens to us and we are the only earning member of the family. We should ensure that our family is financially secured. So next question is, how much insurance do we need? See, basic ballpark figure is minimum 10x of your annual income should be your term insurance plan. This is the first step which you should do as soon as you start earning, and then move on to the next step. So I think this should be the starting step of any financial plan. Okay,
first step is secure the future of your family as well before you dive into other things. So that's step one. But how should investors then move forward, right? I'm done. I'm sorted. I've put that money aside for insurance. Now, I have a long-term story, short-term goals, everything comes into play now. So how should investors define these short-term goals, long-term goals, and how should they follow this?
So the next step would be very simple to ensure that your health insurance is also in place. As per recent data in news articles, 90% of the Indian families are just one step or one bill away from their financial troubles. If they have one hospital bill, they'll be in financial trouble. So next, you should ensure that you have proper family floater plan for yourself, for your partner, for your family, as in your children. And that should be it. Third, you should go about ensuring that you have properly segregated your goals. Short term is anything below 1 year is short term. 1 to 3.5 years is medium term, and other above 3.5 years, I think would be a long term goal, which you should plan for. But before planning your goals, third step, you should even ensure that you have proper emergency fund in place. At least 6 months of your monthly expense should be there in emergency fund, which will be very handy just in case something happens to you, or something happens to your regular flow of income, or there is any bad situation in the economy. This emergency fund will take care of the probably situations which are not in your control.
Okay. Anant, you've highlighted key points coming in: term insurance, health insurance, emergency funds, and then look at your short-term and long-term goals. Now, if I've done all this, then what is my next step and how should I go about with investing? Now, I believe that's the part we come at, right?
Yeah. So when you start investing, firstly, you should budget out everything. Okay. For example, I am right now in Kota and I want to come to Mumbai to the studio for a shoot. I should first know my initial destination. Whenever I am putting anything on maps, first thing I have to put out is where am I standing? So that is the budgeting part. You need to properly budget your expenses. You need to properly budget your income. And based on your income, you should start putting out your goals. Whatever goals you have, firstly, you need to jot it down. Jot down the goals in the sequence of priority. For example, retirement is a very important goal. It's a very goal which you will be prioritizing. Second will be your children's education. Third might be that you want to take a car, or maybe you want to take a home. Then you should jot down that goal. So important is to ensure that we have properly looked after all our goals, and we should first jot it down. Once we have all our goals written down, then we should start mapping our savings, our investments, our SIPs to each and every goal. It might sound very simple, but it's a very important step because you need to sit down with your family. You need to discuss with your family. You need to plan it out. You need to ensure that you have your family mindset in place. You have proper calculation done. What is your expectations 20 years down the line? You need to take inflation in place. So these are the next step which you need to take care of. Once you have the goals, You need to find out how much you need to invest on a monthly basis or on a lump sum basis. And once you have sorted that out, you can probably start investing your journey. Starting journey might be a bit difficult because if you're starting for the first time, there might be some hesitations in your mind. There might be some doubts in your mind. It's absolutely okay. Start with a 5,000 SIP. Start with a 1,000 rupee SIP. Start with a 10,000 rupee SIP. But start. First step is very important in investing.
Absolutely. Starting is that important step. Anant, I just want to understand, right? Because you highlighted so many factors that are important. Firstly comes term insurance, then comes health insurance, emergency fund. That is also important because a lot of people don't keep that emergency fund on the side. And suddenly if there's some situation that comes in, then you're stuck and you are in a bit of a fix. And then comes investment and investing on a regular basis. How should my division go? Suppose if, say, one person's salary is 1 lakh rupees per month, what is the division that I should have in terms of percentage-wise of these investments?
So firstly, if you're earning 1 lakh rupees a month, you should be very happy you're doing really well for yourself. And 1 lakh a month means you are earning around 12 lakh rupees an annum. So firstly, you need to take term insurance plan of 1 crore, which will suffice your purpose. Plus 1 crore accidental plan you can take because since you are young, I am assuming if anything happens in worst case scenario, it will be because of an accident. So 1+1 term insurance plan you can take. Next, for health insurance, minimum 10 lakh plan you should have for your family. And this will suffice your purpose. Also, if you are in a metropolitan city, probably you can look out for 15 lakh plan. But otherwise, in normal situation, 10 lakh plan of family floater will be good enough. Both these combined will give you expenditure of around 4-5 rupees a month. That's it. With just 4-5,000 rupees a month, you have sorted your insurance out. So you have taken majority part of trouble out of your life. Next, you need to ensure you have proper emergency fund, which will be roughly around 6 lakh rupees because I'm assuming 50,000 55,000 will be your monthly expenditure. If we convert it on an annual basis, it will be around 6 lakh rupees. If I ask you to take out 6 lakh rupees all of a sudden, it might be difficult, but probably you can start saving 20,000 rupees a month for your emergency fund till the time you have 6 lakh rupees in that corpus and you can allocate that. Now, you need to see how much extra corpus you have. Probably around 25,000 might be an extra income which will be available for your planning. Then you can start with investing for retirement. Probably 5 to 10,000 will go for your retirement goal. Next, 5 to 10,000 will go depending on your requirement. If you have a kid, probably firstly you should start allocating for education. Of lately, we have seen that education fees have skyrocketed. You need to take care of future expenses of your children, and education being our priority. Firstly, we can start planning for these two plans. And slowly and gradually, once we have our emergency fund, we will have extra 25,000 rupees a month to save. Also, you will be progressing in your life. There will be regular hikes. And slowly and gradually, we can accommodate other goals as well. So this can be a rough plan.
Okay, that's an interesting rough plan as well. Slowly, gradually, first build your emergency fund, education, inflation. That's the hot topic right now, given that it's flying high as well. But, Anant, when you're looking at it, obviously, sometimes there may be some debt repayments that come in as well, right? Sometimes you're taking that car loan. There are other risks that you have to mitigate as well. How should that also be factored into this situation?
See, firstly, if you're taking a loan which is above 10.5%, you should rethink about it. Whether do you actually need that particular thing or you are just taking it to show off. Probably you are taking a personal loan or taking an unsecured loan, which is not a good loan. There are two types of loans. Firstly, they are good loans. Secondly, they are bad loans. Good loans are loans like higher education loans or maybe loans like home loan. These are good loans and they come at a good rate, interest rate. So it's absolutely okay to take these loans. But if you are taking a credit card loan or if you are taking a car loan just to show off to your friends, I think probably you can plan that car in a better way and you can plan that car in 5 years and take it without any loan, which might even ensure that you have proper financial plan. But if you have already taken a loan, you should first list down your loans in the order of their interest rate. Highest loan with an highest interest rate should come out first, and this way you should list down your loans. Now your first target before starting your investment should be to at least eliminate each and every loan which is above 10.5% in your kitty. Focus on those loans, kill them out, make sure that you are not overburdened with loans, and this will be your starting point. So probably your starting point might get deferred if you have a lot of loans right now.
Okay. You know, Anant, the new thing that's coming up now is with AI, and there are so many apps and ways to now just plan your own financial planning. You know, just yesterday I was reading some article how someone actually, or some trader actually went in on one of these AIs and actually made a lot of money. But is that even advisable? Because, you know, that becomes a risk if you don't know how to go. And how should you go about if you are using maybe some app or some online method?
Technology is always good. It
Yeah.
keeps you handy with what is happening around. It makes your job easier. But at the same time, of lately, what I have seen is in last 4-5 years, the number of SIPs which have stopped, number of goals which have gone for a toss, number of funds which people have changed has increased a lot because they have access to a lot of information, a lot of data, a lot of AIs. So probably every morning before even brushing our teeth, we are looking at our portfolio. And if we see that this fund has not done over the last 1 week, over the last 1 month, we probably want to switch that fund, or we want to probably change that fund, which is not a right way. So use technology as your friend and not as your enemy. Over dependency on technology might even disturb your financial plan. Keeping it simple, I always say that we should use KISS principle in our financial plan. Keep it simple and very silly as well. Old principles, I think if you stick to basics, you are bound to make money in this market. If you try a lot of things, if you track a lot of portfolios, if you do a lot of AI stuff, probably you might be prone to a lot of mistakes as well. So use AI, but for your benefit only.
Okay, use AI and make it a friend, not a foe. Don't overuse it. Overusing anything is not good. You know, Anant, important thing now, right? Okay, if everything goes right, I have my emergency funds as well. Then comes my story of SIPs, mutual funds, fixed income. How should I go about in that story? And what should be the division? If someone is a new investor and if someone is already investing, then also how they should go about this. And how often should this be reviewed?
Interesting question and a very important one. I feel which fund you are choosing or in which category you are going depend on your time horizon. If there is a goal which is below 1 year, probably you will use a floating interest fund or a low duration fund. For goals ranging from 1 year to probably 3.5 years, you will use balanced advantage funds as a category or a multi-asset fund as a category. Anything which goes above 3.5 years, you can probably look at equity funds. And if your time horizon is above 7 years, small cap fund is the place where you should be. So if you are investing in a debt instrument for a goal which is 10 years down the line, probably there is mismatch in your financial plan. So you need to accordingly sort it out. So this can be your rough timeline. Annual review at least is a must. Plus, you need to review your portfolio whenever there is a significant change. For example, if you have just had a bonus, or if there is a hike in your salary, or if there is if you have a new baby in your family, probably those are the times where you need to review it even twice in a year because you have some extraordinary situation which has to be taken care of. Or for example, if you have some medical emergency in your family which need immediate funds or which need immediate allocation, you might need to shift out your goals. You might need to change the timelines. So you need to probably review it.
Okay. And Anant, my overall plan, right, what we started with by talking about term insurance, health insurance, emergency funds, and then investment. How often should I review that as well? Will that be basis of any emergency or situation happens? Till then I continue with it? Or is it important to check this out even every couple of years?
On an annual basis is good enough. Probably on your birthday or on Diwali or your anniversary, you can choose a very auspicious occasion for yourself and you can review it on a regular basis. But annual review is more than enough. This will just ensure that you are on the right track. Annual review doesn't mean that you need to change a lot of stuff annually. It just means that you need to see that you are on the right track. That's it. Okay. Probably if market has performed really well in last 1 year, you need to reduce some equity allocation and ensure that your debt equity allocation is again balanced. Or if market has fallen in last 1 year, probably you need to reallocate some debt money to equity money and ensure that proper asset allocation according to your risk profile is being taken care of.
Okay, annually is fine. Pick a day, but do it annually just to check it out. You don't need to make changes, but yes, you can review it annually. That's a word there. Anand, the last one. What are the most common mistakes we've seen investors make when they start out, you know, in terms of financial planning or long-term financial planning? What is the most common mistake? And one that everyone should avoid?
See, I'll talk about a mistake which people are making right now.
Yeah.
I am a mutual fund distributor and I interact with a lot of investors as well on a regular basis. Biggest mistake which a lot of people are making right now is not getting out of their recency bias. They are too much attached to what has happened to a particular sector or to a particular fund in the very recent past, and probably they are driving a car, watching the rear view mirror, and they might maybe probably in next 1 year or 2 years, they may not feel comfortable with their portfolio because they have all invested their money in high risk thematic funds or high risk sector funds. So we need not too much worry about what has happened in last 6 months or what has happened in the market in last 1 year. Probably we need to see that what has happened in the market in last 10 years and then extrapolate it. Whenever in doubt, I think you need to zoom out and then take a view. Don't let recency bias take over your funds or take over your portfolios. Don't become too greedy with a particular fund or with a particular sector. Of lately, we have seen some particular sectors, but for example, defense has done really well and everyone was behind defense sector. Now, many of them are feeling betrayed. They are saying that as soon as I started investing in this particular fund, this fund has underperformed. So this will happen if you let what has happened in very recent past guide your immediate decision.
Okay, Anant, thank you so much today for giving us such an insightful and helpful conversation on how we should be planning our finances. So thank you so much for joining with us on today's edition of Mutual Fund Corner on YouTube.
Thank you so much.
Bandhan Mutual Fund presents MF Corner.